What if I told you that the market literally tells you when it's about to make a big move? That it sends you a signal, a coil, or a squeeze right before it explodes in one direction? Traders, welcome back to the channel. Today, we're breaking down one of the most powerful and popular indicators out there, the Bollinger Bands. But we're not just going to look at what they are. We're going to master a specific rules-based strategy that capitalizes on periods of low volatility to catch high momentum moves. This is the Bollinger Band Squeeze. Before we dive into the strategy, let's make sure we all understand the tool. Created by John Bollinger, this indicator consists of 3 lines. The middle band. This is a simple 20-period moving average. It shows the intermediate term trend. The upper band. This is the middle band, plus 2 standard deviations. It measures volatility above the average. The lower band. This is the middle band, minus 2 standard deviations. It measures volatility below the average. The key takeaway here is that the bands expand and contract with volatility. When the market is quiet, the bands pinch together. When the market gets wild, the bands expand wide. This dynamic is the very heart of the strategy we're about to learn. Think of the Bollinger Bands like a spring. When they squeeze together, it means volatility is at a multi-period low. The market is consolidating, taking a breather. But this quiet period doesn't last forever. This squeeze represents a period of equilibrium between buyers and sellers, but it's an unstable equilibrium. It's building up energy for its next significant move. All right, let's get into the exact rules. This is a day trading or swing trading strategy that works on any time frame, but I recommend starting with the 1-hour or 4-hour charts for swing trades, or the 5 or 15-minute for day trading. Step 1. Identify the squeeze. We need the Bollinger Bands to be visibly tight. A good rule of thumb is that the bands should be at their narrowest point for the last 50 to 100 periods. The price should be trading relatively flat, bouncing between the upper and lower band. Step 2. Wait for the breakout candle. This is the most critical part, patience. We do not guess. We wait for a strong, decisive candle to close outside of either the upper or lower band. A close outside the upper band signals a potential long. A close outside the lower band signals a potential short. Step 3. Enter the trade. Your entry is on the close of that breakout candle or on a pullback to the middle band, the 20-period moving average. Entering on a pullback often gives you a better risk-reward ratio. Step 4. Place your stop loss. Risk management is non-negotiable. For a long trade, place your stop loss just below the middle band, the 20-moving average, or even better, below the recent swing low created during the squeeze. For a short trade, place it just above the middle band or the recent swing high. Step 5. Take profit. There are 2 common ways to take profits. Scale out. Take partial profits when price touches the opposite band. For a long trade, take some profit at the upper band. Trailing stop. Use a moving average, like the 20-period MA, as your trailing stop. You stay in the trade until price closes back below it. Let's make this crystal clear with a real-world example. Look at this chart. See right here? The bands are squeezed tight. The market was super quiet. Now watch this. A massive bullish candle closes above the upper band. That's our signal. We enter long on the close. We place our stop loss below the swing low right here, and then we ride the trend. We could have taken partial profits here as it touched the upper band again, and then trailed the rest with the 20 moving average, getting stopped out for a massive winner. This is the squeeze strategy in action. It's clean, it's rules-based, and it removes emotion. Before you go try this, you need to know this. Don't anticipate. The number 1 mistake is jumping in before the breakout candle closes. Wait for the confirmation. Combine with volume. A breakout with high volume is much more reliable than one with low volume. Context. matters. A squeeze during a long-term uptrend has a higher probability of breaking to the upside. Trade in the direction of the higher time frame trend when you can. It's not perfect. No strategy is 100%. You will have false breakouts. This is why your stop loss is your best friend. So, let's do a quick 30-second recap. Find a chart where the Bollinger Bands are squeezed tight. Wait for a strong candle to close outside a band. Enter on the close or a pullback to the 20 moving average. Place your stop loss below the swing, low or high, or the 20 moving average. Take profit at the opposite band or use a trailing stop. It's that simple. If you found this video helpful, do me a huge favor. Smash that like button and subscribe if you haven't already. It really helps the channel out.